Hey everybody, welcome to your weekend review for the week of Monday, June 27th, 2022. And oh, what a week it was. Monday kicked off with a soft opening for stocks and bonds. Bonds were down 19 basis points early, and the 10-year Treasury was up to 3.198, where it kind of hovered around all day. Last week we talked about the bond market is kind of reacting back and forth between worries about inflation and worries about recession. Today was worrying about inflation. We got durable goods orders, which increased in May by a total of 0.7%. So durable good orders were up 0.7%, while shipments increased by 1.3%, adding to some hope that maybe some of the supply chain issues are clearing up. Pending home sales were up 0.7 in May, according to NAR. Northeast saw the biggest gain, with home sales rising by 15.4%. We had a weak 5-year bond auction in the middle of the day, which kind of led to some selling. Like we said, we opened up at down 19 basis points. We closed the day being down 30 basis points total. We're kind of range trading down here at that, still the same range we've been watching for a couple of weeks now, with a ceiling of 100.603 and a floor of 99.281, with an even stronger floor down at 98. So we're going to have to watch how bonds behave this week, because pretty much every day we have news that can move the market. We also got a news report over the weekend that more than 8.4 million Americans are late on their rent, which is about 15% of people. As you can see from the graph, about 2 million of those make less than $25,000 a year. About a million make less than $35,000 a year, and another 500,000 make between $35,000 and $49,000. So that's a lot of people impacted by the downturn in the economy. News also came out that First Guarantee has laid off almost its entire staff on Friday, backed by PIMCO. They were short on cash and unable to raise more money, so they laid off pretty much everybody. This is in the wake of JP Morgan Chase saying on Wednesday that they were laying off some employees, though no numbers were given, and reassigning others in its mortgage business to other divisions. Another kind of cool commentary today from Brent Niatre. Hope I pronounced his name right, because he's a smart dude. He pointed out that the 2018 financial crisis never witnessed a rebound in home construction. That overhang was probably balanced out by the mid-teens. However, new home construction never really picked back up in anywhere in the country, which is why we have such a shortage today. Also saw this graph in a webinar I was on today, which shows, also saw this graph today on a webinar that I found interesting. They had went through and pulled stats for the major home buyers in America, being Invitation Homes, Progress Residential, Cerberus, and American Homes for Rent, and they showed in several of the metro populations how many homes they own. So between just those four, they own almost 35,000 homes in Atlanta, over 20,000 homes in Phoenix. They own right around 15,000 in Dallas, Fort Worth. So you can see that these have been very active buyers in the market. Bonds opened down 20 basis points early on Tuesday the 28th. A lot of money flowing into stocks on further easing of COVID restrictions in China. A lot of attention is being paid on the shorter end of the yield curve, meaning the 2-year and 5-year Treasury rates, after Jerome Powell recently drew attention to these when he was asked, how do you know when you're going to stop raising rates and when it's working? He had mentioned they were going to look at the short end of the curve's real interest rates, which is the interest rate offered on the Treasury minus the inflation. Currently, the 2-year minus inflation is around negative 60 basis points. This is important because since 1990, the Fed has never ended a tightening cycle with negative real rate policy. So that tells you how far we have to go in order to stop raising rates and ending the Fed action. Many eyes are also on the core PCE number, which is coming on Thursday. New York Fed president also brought up the neutral rate environment. This is where the Fed funds rate minus core PCE is greater than or equal to 0. Currently, the Fed funds rate is at 1.5%. The core PCE is at 4.9%. The New York Fed president said he wants the Fed funds rate to be around 3 to 3.5% and get core PCE down to 3 by the end of the year. Sure, and I want Santa to bring me a horsey. with the projection Thursday of a plus 0.4% increase in core PCE. That means that core PCE would go down to about 4.7%. So there's a lot of work to be done, but this is one of those where the old saying is, when you are a hammer, the whole world looks like a nail. So the odds are the Fed is just going to keep swinging that hammer harder and harder until the whole damn thing breaks. We'll end up in recession. But in housing stuff, we got good news today. Housing prices in general were up 1.6% month over month, which is 18.8% year over year, according to the FHFA House Price Index. The S&P Case-Shiller, which is a more thorough measure, showed that prices were up 20.4% nationally, and in April it went up 1.8% month over month. A small dip from March's reading. But most of the 20 cities saw gains month over month, with the largest leaders as Tampa, Miami, and Phoenix. MBS is still in that 100.603 to 100.281 range, though it looks like it might be gearing up to make a run at that floor. We'll see if that holds. The next line is only a quarter lower. Surprisingly strong showing today, given a bumpy 7-year note auction this afternoon. So that didn't help things, but a lot of money flowed out of the S&P. Like we said earlier, it was 20 points up early and ended up being down 78. So a lot of money came out of stocks and into bonds, which helped us out in the afternoon. CoreLogic's single-family rent index came in as being up 14% year over year. So it's not like people can avoid buying houses to save money. These numbers are staggering. Miami was up 41% year over year. Orlando was up 26%. Outside of this is it's going to add to the inflation numbers. New York Fed also released its next agency mortgage bond schedule. Came out this afternoon. The numbers are pretty stark when you look at them today compared to what they were in the past. Monday, the Fed total purchases of agency MBS came in at $719 million. This is a far cry from the $41 billion that was purchased in March 27th of 2022. So you can see the numbers in that paragraph there of how much it took spending taxpayer money, which is your and my money, to buy down the bonds to get the rates down to where they used to be. Let's make no mistake about that. This isn't just magical money that is owned by the government. They're issuing debt to buy these bonds, and that's where the money really comes from. Last year, we saw the central bank take down an average of $5.3 billion per day in mortgages. So that really gives you a sense of what it takes to move the market back down as low as it was. And, it tells you that we're really going to have to get into a pretty bad recession to get the bond market, or to get the Fed to spend that kind of money again. Let's hope our world doesn't get to that point. Which brings us to Wednesday, June 29th, 2022. U.S. bonds found several sources of inspiration for overnight losses in the form of German data. Got a couple of reports out of Germany showing less inflation than previously thought. However, that came back around when Spain posted the highest numbers in inflation since 1985. We also got the final revision of first quarter GDP, which came in at a negative 1.6% rate, a downward revision from the 1.5% negative reading before. PCE price index, which is basically inflation, was revised upward to 7.1%. Excluding food and energy, it rose to 5.2%. If you remember from yesterday, the New York Fed chair said he wanted to see that down at 3 by the end of the year. Good luck with that. The latest GDP Now estimate out of the Atlanta Fed has growth increasing 0.3 in the second quarter, which since that is a positive number, would make it so we aren't technically in a recession. Reminder, a recession is 2 quarters of negative GDP. However, a 0.3 number is pretty bad, and it could change rapidly. Home prices rose 22% in May, according to the Clear Capital Home Data Index. Southern region rose 23%, mainly because of Florida. Keep in mind that this index is actually a month ahead of the FHFA and Case-Shiller, which we got yesterday. So the rise in rates hasn't hit home appreciation yet. Yields were down 6 basis points on the open, then turned around midday Eastern time. Correlation isn't causality, but a lot of that stuff started changing around the time that Fed said at the ECB meeting, we understand better how little we understand about inflation. Kind of reminds me of a quote from one of the recent elections where somebody said we need to educate these kids so they're smart enough to know how dumb they are. But we ended up today in a positive territory. So we're up 45 basis points on the MBS. The Treasury, the 10-year Treasury was down 12 basis points, making a run at that 3% mark. And the 4.5 is up over 100. With national home prices increasing at 20% annual rate, it brings up another phenomenon. The average loan size being pooled with Fannie Mae, Freddie Mac, and Ginnie Mae are now at all-time highs. The average loan sizes have increased 20% each over the course of the last handful of years, all record highs, which poses an interesting risk because higher loan sizes show a higher probability of paying off, possibly if rates drop next year, which is kind of why you are not seeing a ton of rebate on your rate sheets. We also have a post today from our sponsor at www.WellThatMakesSense.com. This is from a podcast series by Naval Ravikant, who is a very, very smart guy. There's a big focus in the tech world and in general about working hard. However, he makes a good argument that there are a couple of things you need to consider before working those 60, 70, 80-hour weeks. And check it out at www.WellThatMakesSense.com. And then we had Thursday, June 30th, 2022. Happy end of month, everybody. Hopefully you survived it and it was profitable. We had a good open for MBS being up 22 basis points real early and kind of stayed around there all day. Tough open for stocks being down 68 points early. Recovered some of that throughout the day. Market is digesting press conference material from Jerome Powell yesterday. He was quoted as saying, "We understand better how little we understand about inflation," as if that wasn't evident by a year and a half of saying that inflation was transitory. He also took the time to blame a lot of it on the supply chain plus the war in Ukraine, with zero mention of the trillions of dollars worth of stimulus that was pumped into the economy super fast. Right or wrong, it impacted things, so you need to mention it. He also stated yesterday that he was more concerned about the risk of inflation than the risk of recession. Said there is a chance we could go too far. That's certainly a risk. Yeah, it sure is. Purchases of goods and services adjusted for changes in price decreased 0.4% in May after a downwardly revised 0.3 gain a month earlier. Also, April was revised lower by 0.4%, which could lead to lower updates to GDP projections. PCE, or personal consumption expenditure inflation, was up 0.6% from previous month. We expected 0.7, up 6.3% year over year. Core PCE, which is the Fed favorite, was up 0.3%, less than expected. Initial jobless claims decreased 2,000 to 331,000, which is still very low, and continuing claims decreased 3,000 to 1.328 million, just above a 50-year low. Interesting thing of note is how inflationary expectations tend to have reinforcing few syllables right there. People tend to accelerate purchases in order to buy before prices increase. So when people are expecting prices to go up, they will buy a whole bunch more stuff now versus later, which leads to inflation. MBS are making a run at that double ceiling of the 25-day average plus the line at 100.603. We closed the day at 100.36, which was up 27 basis points. Saw gains all the way across the spectrum, although the Ginnie 2 30-year at 3.5 saw the biggest gain at up 53 basis points. We're still battling, running up towards that line. Hopefully we make a run at it tomorrow. That would be pretty cool. We also got news that First Guarantee Mortgage Company files for Chapter 11 bankruptcy protection after laying off almost all of their employees last week, which is real interesting considering I'm hearing rumors that they had a pretty expensive corporate retreat in Florida within the last 2 weeks. Probably could use that money to save some jobs, but what you gonna do? And on Friday, we had a great start to our holiday shortened Friday, with MBS being up 77 basis points early. Stocks were up slightly as well at the beginning, a lot of the focus being on stocks and risk assets, as recession fears have overtaken inflation fears. The sentence is great here. Contracts on the S&P 500 and the NASDAQ 100 pointed to extended declines for U.S. stocks after the S&P 500 suffered its biggest first half of the year drop in over 50 years. That's not good. After the PCE report was yesterday and the previous report was revised down by 0.4, the Atlanta Fed has revised its estimated second quarter GDP from being 0% to minus 0.1%, which doesn't seem like a lot. However, that would meet the technical textbook definition of a recession, with 2 consecutive quarters of negative GDP growth. MBS have broken through its old ceiling at 100.603, closing at 100.77 today. The 0.603 will be the new floor. The bonds had 3 hours fewer to trade today, but it made up a lot of ground in that time, with the 10-year Treasury being down 9 basis points at 2.889, breaking through the previous floor at 3%. The new floor is 2.6%. Great day all in all. However, we lost some ground versus the morning as the day went on. Stocks picked up a little bit. We ended up being up 41 basis points on the day for the MBSs. They made a run at the 50-day moving average, however, failed, like we said, ending at 100.77 with a new ceiling of 100.933. We also got a new post from our sponsor, WellThatMakesSense.com. This is another post from the podcast by Naval Ravikant on how to get rich, where he talks about all of the things you need to do in order to get rich in his system. Take time. So being authentic will help keeping you doing it over and over again. And don't keep track of the incremental progress. Just stay with being authentic, and it'll help you get to where you need to be. Taking a look at next week's schedule, we are closed on Monday for the holiday. Yay, America. We have jobs week. So these are the big things that will come in next week. On Thursday, we are getting the ADP employment report. We'll get the BLS on Friday. And that will be the biggest things moving the markets next week. Hope everybody has a great weekend. Checks out our sponsor at WellThatMakesSense.com and learn some good stuff, and all of our other common sources and influences. Have a great weekend and stay safe. you.